Oh, that's real good.
Hello everyone, and welcome to our channel Penny Lesson. We talk about everything finance, from tips on making money and proper investing to news about the different economies and situations affecting the global markets. The goal of this channel is not only to teach you how to be more financially responsible but also to teach you how to be more aware of global events. So why not just sit back and relax while we tell you what's happening in the finance sphere? Be sure to subscribe to my channel and hit the notification bell to be constantly updated on my latest videos. Remember, one penny lesson a day keeps being penny less away. The S&P 500 is down 20% this year as interest rates continue to rise. We recently received the most recent inflation statistics from the Bureau of Labor Statistics. The Consumer Price Index has increased 8.3% over the past 12 months, with a monthly adjusted monthly increase of 0.1%. The staggering 10.6% decline in gasoline and 5.9% drop in fuel oil represents a 0.1 gain month after month. Core inflation, which excludes energy and food, rose 0.6% in August, reversing the downward trend seen since March. The underlying core inflation figures put a damper on everyone's hopes that this inflationary phase is ending and put to rest the notion that interest rate hikes could have been scaled back despite the headline rate continuing to drop. In reality, Jerome Powell recently announced a further 0.75% interest rate hike, also known as the 75 basis point hike. This is relevant because it happened just a few days ago. He stated the following at the news conference. The FOMC increased its policy interest rate by 0.75 percentage points today, and we believe that further rises will be necessary. We are consciously adjusting our policy stance to a level that will be sufficiently restrictive to bring inflation back to 2%. Maintaining a restrictive view on policy for some time will probably be necessary to restore price stability. The historical evidence strongly advises against easing policy too soon. With the assistance of our good friend Charlie Munger, I want to focus on what you, as an investor, should anticipate during an inflationary time in this video. He lived through the great U.S. deflation from 1930 to 1933, the extreme inflation of the 1970s, and the absence of inflation in the 1960s. The 1970s are the most recent similar period, and Charlie is concerned that the current situation may end up being worse than what existed before Paul Volcker's intervention and system reset. What do you think about the inflationary environment right now? Please draw comparisons to the 1970s. It was a terrible recession when Volcker raised the introductory rate to 20%, but the government only paid 15% on its bonds. Scarce circumstances made it possible for Volcker to accomplish that without hindrance from lawmakers. The willingness of our current politicians to allow a new Volcker to be so severe with the economy and trigger that kind of recession is not something I would foresee. Therefore, I believe the current problems will differ from the past ones. You might prefer the recession you'll have to what Volcker experienced. The difficulties we face could be more severe than that Volcker faces. Everyone has a strong opinion about politics. Anything political is subject to intense scrutiny. Therefore, you could say that it's improbable that anyone who has read a book by Paul Volcker so much will be appointed to the top post, given the current state of political unrest and the fact that the Federal Reserve's chair is a position chosen by the president. Of course, Paul Volcker is the head of the Federal Reserve, who aggressively increased rates to 20% to stop the extraordinarily high inflationary period of the 1970s. By doing so, he sent America into a severe recession, but in the end, his resolve brought the inflation rate under control. However, you could argue that the political willpower to take decisive action and stop inflation may not be present, given the politicization of economic indicators, stock market crashes, and recessions in today's world. Politicians may be concerned about the political repercussions of purposefully starting a recession. All of that would result in stagflation, which Ray Dalio predicts will happen, an extended period during which inflation stays high, but the economy remains weak. According to conventional economic theory, The previous 2 years have seen the greatest inflation in 40 years due to excessive monetary and fiscal stimulus. What are your thoughts on this? We've taken quite drastic actions, and we have no idea how severe our problems will be or whether they will be significantly worse than in Japan. You have a lot of interest-bearing debts, and you use checking accounts with no interest to pay them off. If the money supply increases, interest payments are eliminated. They could be utilized excessively. Naturally, that's precisely what's happened. COVID occurred. We are currently dealing with the effects of the Fed's unprecedented printing of trillions of dollars, which drove inflation into overdrive. The Fed must eventually raise rates, and doing so quickly frequently slows down the economy to the point of a recession. But now that it has been said, let's concentrate on how to manage current economic times as an investor. Let's face it, investors find it challenging during periods of high inflation and low interest rates. Staying in cash is bad because inflation reduces the purchasing power of your money. Being invested is also a drag because the Federal Reserve restricts business borrowing and consumer spending. What are we to do? Other than buying high-quality stocks, what is the greatest recommendation for individual investors to deal with the negative effects of inflation? You might have to pick the choice that isn't as horrible as the others. The Mungers own apartment buildings, Costco, Chinese, Berkshire stock, and some Daily Journal stock. You don't need all this diversification, which is a terrific lesson from the Mungers. If you have 4 valuable assets, you're fortunate. Picking the least awful choice is sometimes necessary. It's a nod to Warren Buffett's first investment rule: avoid losing money. Investing can be challenging when the market isn't working in your favor. We may remain rational, adopt a long-term perspective, buy high-quality stocks, and consider the future more than the next 1 to 2 years. Remember that you mustn't constantly acquire and sell 1 million stocks. Over the long run, you must discover 4 or 5 golden opportunities throughout your investment career and maintain a long-term perspective. Shortly, who knows, you might experience inflation and suffer a 30% loss during a downturn. It's a group of excellent investments that have consistently performed well over time, and it's sufficient for him. In my opinion, most individuals feel the need to be active in the market at all times. Charlie has already discussed this on several occasions, and I believe that, especially in situations like this, it can be helpful to step back and evaluate your portfolio with the traditional long-term tenure attitude. We have a stock market that some people use, just like a casino, and those who love the casino and want to make long-term investments utilize it. He simulates it in one market, which spirals out of control as a result of the stock market turning into a gambling venue. What we are getting is dangerous access for the nation. When the going gets tough, we must maintain our composure, consider the long term, and refrain from making snap judgments. If you own a few high-quality companies with well-known distribution channels that give them price power, feel free to resume your slumber until this situation is resolved. You might also wait patiently in the background until the short-term focused market presents you with an amazing long-term opportunity. An investment is based on the notion that you should receive more value than you paid for. You need to generate more income than you spend if you want to succeed. Wow, was that news? Why not ponder it? Want to know the latest? Comment if you want more articles like this. This video is just one of many videos on my channel that brings you the latest news about the world of global finance and economics. So go hit that subscribe button if you don't miss out on content like these. If you enjoyed this video, please hit the like button. Thank you for all your support, and I'll see you again next time. Remember, 1 penny lesson a day keeps being penny less away. Cheers.